Dealerships know exactly how to sell you a vehicle. They slide a piece of paper across the desk and focus your eyes on one single number, the monthly payment. It is structure designed to get you to sign quickly, without calculating the total weight of the financial commitment you're actually making. To see how this works, let's put two buyers with the exact same $55,000 salary in the exact same dealership. They both want a brand new $30,000 sedan. Same model, same color. Here is the comparison table. Option A is a 36-month lease, $2,000 down, $299 a month. Option B is a 60-month loan, $3,000 down, $522 a month. Option A feels smarter. The leaser saves $223 monthly, protecting short-term cash flow. Add in the comfort of a full manufacturer warranty, and the lease structure looks airtight. Air conditioning dies in July? Covered. Need new brake pads? Covered. No surprise bills and no anxiety. The structure of these two deals goes deeper than the monthly premium. Every dollar our buyer spends is securing ownership of an asset. Every dollar our leaser spends is renting a piece of that exact same asset. The decision you make at the dealership dictates your timeline. Are you putting yourself on a permanent financial conveyor belt, or are you heading toward a definitive finish line? And what does this choice actually cost you when the cycle is over? Let's roll the clock forward and evaluate the math across the first 3 years of driving. During this period, our buyer is feeling the strain. He is paying that steep $522 premium every month, while watching the value of his new car plummet the second it leaves the lot. By year 2, his $30,000 car is worth about $20,000 on the open market, but his loan balance sits at $22,000. He owes more than the vehicle is worth. That is called being underwater, and psychologically, every payment feels like it's vanishing into a hole. This timeline graph tracks the total net out-of-pocket cost for both drivers. Plotting the first 36 months shows a clear divide. The buyer's cost curve rises rapidly due to the higher down payment and monthly rate. The leaser's curve sits comfortably below it. On paper, the leaser has spent $9,028 less in cash flow than the buyer by month 36. Standard financial advice often fails to resonate at the dealership because buying a car does feel worse early on. It creates a powerful, localized illusion that leasing was the undeniable smart play. Then month 36 arrives. The lease contract expires, and the car must go back to the dealer. This is where the dealership's marketing playbook relies on the fine print. Look at this final invoice. The first hidden trap is the mileage cap. Standard leases allow 10,000 miles a year. The average American drives 13,500. At 15 to 25 cents per mile over the limit, driving like a normal adult triggers a penalty of $750 to over $1,200 due on the spot. It erases a significant chunk of the cash flow our leaser thought he saved. Next is the wear and tear inspection. The leasing company, not the driver, dictates what constitutes normal wear. A coffee stain on the back seat or a ding from a parking lot can easily translate to highly subjective penalty charges. Finally, the disposition fee. If you simply hand the keys back without signing a new lease, they charge you $300 to $500 just to process the return. To avoid swallowing these combined exit fees all at once, 80% of leasers take the easiest path available. They sign a new lease. They get a new car, a new contract, and their payment clock resets to zero. The alluring $299 monthly payment is actually subsidized by these back-end penalties. They are specifically designed to lock drivers into a permanent cycle of renting. Let's push the timeline to year 6. This is where the structural difference between the two paths permanently separates. Our buyer reaches month 60. He makes his final loan payment. His monthly obligation to the bank is now exactly zero. Watch what happens on our timeline graph. The buyer's out-of-pocket cost curve flatlines. He spent over $34,000, but holds the title to a vehicle worth $12,000. We subtract that asset value, and his effective net cost drops significantly. Now look at the leaser's curve at year 6. Having completed 2 consecutive 3-year leases, he has spent over $25,000, and he owns 0 assets. The math has officially flipped. Project this out to year 10. Across 3 to 4 lease cycles, the leaser's total spend hits $45,000 to $52,000, with 0 equity to show for it. The buyer isn't getting off completely free during this time. Without a warranty, he is shouldering the full burden of aging parts. He's paying for the inevitable cracked belts, new tires, and the occasional $2,000 transmission repair. But even factoring in thousands of dollars in repairs, the buyer still wins the decade. Vehicle depreciation slows down drastically after the first few years. The buyer retains a tangible asset while keeping thousands in avoided monthly payments. By year 10, factoring in all loan costs, repairs, and retained asset value, the buyer has spent $15,000 to $25,000 less than the leaser. People repeat this process multiple times over their adult lives. Multiply that 10-year gap across an entire driving lifetime, and you are looking at a six-figure wealth advantage. Buying is a front-loaded investment. Leasing is a permanent wealth drain. I'd be ignoring reality if I said leasing never works. There are specific profiles where the math leans in the other direction. Look at this decision flowchart. If you're a business owner, you can often write off lease payments. That tax advantage erases the buyer's lead. The second exception is luxury vehicles. They carry out-of-pocket repair costs that become genuinely catastrophic once the manufacturer warranty expires. A $4,000 brake job or a complex electrical failure on high-end German engineering will ruin your month. For these specific profiles, leasing functions as a highly efficient risk transfer tool, an insurance policy against unpredictable cash flow disruption. But the vast majority of us are standard commuters looking for reliable transportation. To unlock that six-figure wealth advantage, you have to be willing to tolerate the unpredictability of paying the mechanic directly. You trade the anxiety of the dealership's monthly payment for the occasional frustration of a repair bill. It requires discipline. It means driving an older, paid-off vehicle with 50,000 miles instead of chasing a new interior every 3 years. Blindly making a multi-thousand-dollar decision based on a single monthly payment without calculating the true cost over a lifetime is the true financial trap.